Well, greetings everyone and welcome to another Outlook for 2025 video. Today we're going to talk about the fascinating, and I genuinely mean it now, subject of high quality corporate bonds, which typically would be less interesting than other subjects we're talking about today, things like asset-backed securities and credit from around the world. But at the moment, the UK bond market is the focus of the world.
It's surprisingly not dull for once.
It's not dull. Perhaps we wish it was dull, given we're on the hook for all this debt. But never mind, we'll come to that in a minute. Let's talk about 2024 now. Last year we said at the start of the year we thought it'd be a good year for fixed interest. It was. We felt the fund was well set up to outperform. It did by some 250 basis points. Overall returns of 5%. A good year. Put it into context.
I'd say it was a good year with some big challenges, because you might remember we started the year with the world thinking there were going to be 6 or 7 rate cuts, and then we got 2 or 3, and the yield curve steepened significantly, which put pressure on the long end of our longer dated corporate bonds, had quite significant capital losses. So it was challenging producing decent returns when the yield curve was changing shape so aggressively based on stickier inflation.
But you managed to do so.
We managed to do so, so we felt we actually had one of our best years ever in terms of relative performance. We were positioned for the yield curve steepening, and we had the most credit risk in quite short dated bonds, which benefited from a higher yield but also some capital gains on top, which really helped us beat the benchmark by nearly 300 basis points.
Well, for which we're very grateful as we come towards the 10th anniversary of the fund and working together. It's been a great experience, and the start of this year has been a bit more challenging already.
It is.
I'm not talking necessarily about UK corporate bonds or your fund, but more about the sort of backdrop in the UK gilt market. I sent a note around today which will be less knowledgeable than your own experience and understanding these markets, but talking about whether or not it's a worry or an opportunity, what we're seeing in the UK gilt market. What would be your own personal view on that?
It's a really tough one, because I'd say it's a bit of both, and that's a real middle of the road answer.
Well, it is. Yes, okay.
So I'd say what's really driven in the last month has been the same factors that have taken treasury yields higher. However, in the last week, we are now seeing more of a divergence and underperformance of the UK.
Idiosyncratic problem for the UK.
It is. So I think it's now setting in that we have a bit of a growth problem now in the UK. Tax revenues perhaps might be lower than new Chancellor Reeves had estimated, and therefore maybe she'll have to come back and either cut spending or go for another tax grab, which is not great for the gilt market either way. And we've seen a bit of steepening. Now, there's also been some technical factors around some very big corporate bond deals or tender processes that happened this week.
New issues? Or?
Well, it's an Annington tender, which is effectively being hedged by selling gilts against it, and that was £2 billion yesterday, right at 11 a.m, which is when the market started selling off. So
right, an unhelpful time as well.
Unhelpful, and I think liquidity is a bit thin at the moment in January. So there's a few technical
even in UK gilts?
Even in UK gilts. So there's some technical factors on top of some deteriorating fundamentals, you might say. So ultimately, the UK curve is now quite substantially steeper than the US curve, which means I think there is an opportunity there. In fact, I personally bought some gilts yesterday, some long dated gilts, 61s, because
trading a long way below par.
Exactly, and there's very low coupon gilts, 0.5%. So in fact, you don't pay capital gains tax on any gains you make on that gilt. So actually, it can be, if you've got a long-term horizon, 2061 is a long time away.
Well, a long-term horizon or a very good short-term trade as well, can't it?
Exactly, yes. So that's a cash price now of 25.
Yeah.
So, you know.
It was cheaper 30.
Yes.
Yeah.
Exactly.
So what's the strategy here for the Labour government? Is it hope? I mean, anyone could see from the budget announced at the end of last year, it was extreme on the basis that it just exacerbated the problem. The balance of the books already not matching just made that worse. So what can they do here to re-engender at least a modicum of confidence?
It's tough, because I think Rachel Reeves in particular has boxed herself into a corner by saying she's not going to touch the big rates of tax. So either
which in itself was foolish, to be honest.
Absolutely. So she is going to breach her fiscal rules, I would guess, at this rate. Feels to me like 10-year gilts could breach 5%. 30-year gilt yields now the highest this century. You have to go back to the last century to see the higher.
And on the 10-year, it's the highest since October 2008.
Exactly. So all of these things suggest to me she's either going to have to cut spending or come back for more tax revenues. But I think we're already getting into tax trap territory here, where higher rates will result in lower revenues and a compounding problem here. So ultimately, I think the bond market are going to make the party sit up and make some changes to what they had.
Can she do that and keep her job?
It's tough.
I would say so.
It's very tough. Yeah. So I think it depends. There's a lot. You can see the poll ratings at the moment for the entire government are not good. there is a risk.
It's been an inauspicious start.
It has. So
Things can only get better.
Things can
Which I
only
think
get
was
better.
labelled down for all those years ago, but there we go.
Exactly. So I think it's going to be tough, and I think they're fighting a few fronts at the moment, and it's possible she could ultimately be thrown under the bus, so to speak.
Okay. But in terms of UK corporate bonds and the outlook, so the UK corporate sector does not have the problems it had 15 years ago. It's in pretty decent health.
That's right.
Yes, it's a problem over profits potentially, but that's the difference to an insolvency issue. Areas like the banks still look to me to be pretty rock solid. I think the outlook for the UK economy is not very good, but it's not disastrous. If the global economy as a whole has a sort of a slow but positive economic experience this year, the UK will probably be there or thereabouts. A bit lower than the US obviously, but not out of the mix of the other G7 economies. Mm-hmm. So presumably the fact that we've now got higher yields is a good thing.
It is. So we have no default risk concerns. It is a higher quality fund, this of course, but we don't have any sector exposure that we're worried about in terms of fundamentals. It's really a valuation question we have. Some sectors are looking tight. You mentioned financials, that happens to be our favourite. Fundamentals are rock solid, and you get better valuations, we believe, in financial bonds. So insurance...
By taking a lot of risk?
Not necessarily. Well,
okay.
It depends how you define it. I would say no, because we're keeping these bonds short dated.
Okay.
They're still investment grade, but they are subordinated, so you run an element of call risk. However, our insurance sector exposures made more than 10% last year. And these are bonds with 3 or 4 years maturity. They're still yielding 7% in some cases, and I think you can maybe get a small capital gain on top. So for us, that's still where I'd rather have my risks in shorter dated financials with very strong balance sheets, rather than, say, long-dated utilities or telcos, which aren't going to go bust, but they might see a little bit of spread widening, given spreads are historically very tight.
And I guess also when it comes to the question of duration and what element of corporate bonds you buy, there has to really be the question of why would you bother going out any longer than 7 to 10 years? Because you're in a situation where you've got enough predictability, enough yield, and enough a sort of guarantee of return in the next 5 to 7 years, and you probably do get the benefit of if interest rates are cut anyway. You might not get any of that at the long end, would you?
Exactly, and that's how we're positioned in the fund. The very long dated
for more curve steepening.
A little bit more curve steepening.
Okay.
We did see a lot in 24, so
Yeah,
we're not expecting that to the same extent, but a little bit. And we'd rather have gilts at that part of the yield curve which have no spread risk. We'd rather, by contrast, have all of our credit risk in less than 10 years to maturity, and most of it is around 3, 4, 5 years in fact.
Okay, so how are we managing the overall duration of the fund? And let's then talk about the yield. So typically you've managed the fund very successfully by buying your favoured corporate corporate bonds and credit instruments in the sort of 1 to 5 year range, and then having some interest rate futures alongside that to manage the overall duration. That remains the same here?
It does, and so, but our duration is the closest to benchmark we have been in many, many years. You mentioned the fund is coming up on 10 years old. This is actually the closest we've been to benchmark duration. We're only a quarter of a year underweight duration, but in terms of the risk profile of the fund, we're still positioned for more yield curve steepening.
Okay, and taking credit risk at the short end,
yes,
and duration risk using government bond futures in the belly of the curve.
Exactly.
Okay.
And we've got more earnings visibility, we've got more capital protection in shorter dated bonds, so that's really where we'd rather put our firepower in terms of credit risk.
Okay, and the overall yield on the fund, Chris, just put that into context, and what will that mean if we translate that into prospective returns for the year ahead, which I won't hold you to. But,
Exactly, yield 6%. So I'm thinking you're going to get 6% plus a little bit this year. So I'd say something like 7% total return. What worries me is the average level of spreads is very tight. I think it could widen by something like 30 to 40 basis points over the course of the year.
And still within a normal range, let's be honest.
That's right. But I think we're still likely to get 2 rate cuts in the UK this year. So effectively the rates curve will give you back the spread widening.
Okay.
So you'll get yield plus a little bit.
It's a zero-sum game, yeah.
Yes.
Okay, very good. And in fairness, if you think about the 5% return you generated last year, and the year before that there was a healthy positive return as well. 2022 is fading into the memories, but that was the setup for a few years of better returns. If the message is that through high quality UK corporate bonds, without taking an excessive amount of risk, as we just described here, you can get a return of in and around 6%, I mean, that's still really quite attractive, isn't it?
I think so, and I'd rather we are in this higher for longer narrative world where we're not getting capital gains, but we're getting a healthier yield that will sustain us for more years of decent returns.
It's as simple as that.
Hope so.
Well, the year hasn't started like that, but it's a time of wishful thinking, so it's all good. But we're very appreciative of the efforts the last 10 years, and last year was excellent, and we're looking forward to a good return again this year. So
My pleasure.
thank you for your time.
Thanks very
Thank you.
much, Tom.